Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Fall Webinar Series. This program is entitled Top 10 Considerations Professionals Must Know When Assisting Families with Special Needs. For those who don't know me, my name is Jonathan Shenkman and I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 to 25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Before I introduce the speaker, I'm excited to share that I'll be hosting one more program this year. This webinar will be for 3 CPE credits and 3 CLE credits for accountants and lawyers based in New York and New Jersey. All are welcome to attend. If you're not interested in the credit, also you could attend. Be sure to stick around to the end of this program where I share more details. Today, we're privileged to hear from Amy O'Hara, who's a certified elder law attorney and partner at Littman Krooks based in White Plains, New York. Amy focuses her practice on special needs planning, trust and estates, elder law, and personal injury settlement consulting. She's a sought-after speaker, frequently speaks to advocacy organizations on the importance of proper planning for families of children with special needs. Amy regularly publishes articles relating to elder law, estate and special needs planning. She is the treasurer of the board of directors of the Special Needs Alliance and is also the president of the board of directors of Westchester Disabled on the Move, a not-for-profit organization that aims to improve the quality of life and the rights of all people with disabilities. Today, Amy will be speaking on top 10 considerations professionals must know when assisting families with special needs. With that introduction, I'll now turn the program over to Amy.
Thank you so much, Jonathan, for having me today. I'm going to get started because I have a lot for the next probably 25 minutes here. So special needs planning, when we're looking at disabilities, more than 56 million Americans are living with some type of disability, whether it's mental health, cognitive, physical, which makes up 19% of the United States population, as many as the entire state of California. 1 in 6 children ages 3 to 17 have one or more type of developmental disabilities, which could be ADHD, dyslexia, and 1 in 44, and I recently updated the statistic because before I had 1 in 59, but 1 in 44 children have some form of autism or on some type of spectrum. So when we're looking at this planning, even though certain practitioners or planners, whether it's accountants or financial planners or attorneys, this is not their area of expertise. It's important to know certain aspects of the plan, which I'm going to highlight just 10 of them today. And when we're looking at special needs planning, sometimes the disability is significant enough where an individual will qualify for certain types of government benefits. And I like to break them down as means tested and non-means tested. Means tested means that there's an asset and or income test. And those make up supplemental security income, which is for individuals who are 18 or over who have basically no assets and no income. They could qualify for a monthly check. And then Medicaid, and oftentimes if somebody here in New York, for example, if somebody receives SSI, they have automatic Medicaid eligibility. And oftentimes when we're looking at Medicaid eligibility, we do not need it to take the place of private health insurance, because what an individual could get under private health insurance is oftentimes much better than what we could get in terms of care under the Medicaid, although it has certainly gotten much better over the last couple decades. But where we get Medicaid, and again, here speaking if it's New York based, but it applies to other states, is through waivered services. OPWDD, New York State Office of People with Developmental Disabilities, provides a vast array of various programs, whether it's care at home, where it could be respite, it could be community habilitation waiver, it could be learning community skills, or it could be residential placement or day programs when somebody ages out of the school district, which is required at age 21. And these are some examples of the means tested. So when oftentimes I'm working with families, they may be very financially well off and may not be concerned about SSI or even Medicaid because they have great, insurance, but they will need to get in the system for that OPWDD. Non-means tested benefits, and actually back from Medicaid, an individual needs to have less than $15,900 in non-exempt assets in order to qualify for Medicaid in New York. It varies state to state. Some states have a $2,000 limit. For non-means tested benefits, we're looking at Social Security disability, whether an individual qualifies based upon their own work history, and they have enough quarters, at least up to 40 quarters in the system, or they qualify based upon their parents' record because they were disabled before the age of 22 and are not able to work because of that disability. The Medicare, and then with the Social Security disability, they could qualify for Medicare, which is great, which is the same Medicare that we all qualify at age 65. There's no income and asset test for these types of benefits, and as well as special education. So just a 1-minute primer on trusts when we're looking at special needs planning. When third-party supplemental needs trusts are probably the most common, and their name, what the name says, they're third party. They're funded by third parties, usually parents when they're doing their estate planning for their child, and that their estate plan will funnel into this third-party trust for the benefit of their child at their death or through lifetime contributions to the trust. First party supplemental needs trust is where the beneficiary themselves has assets in their own name, whether they had a settlement, perhaps a birth injury, malpractice, or they received an inheritance for a grandparent or a parent who didn't properly do their planning. Both of these trusts are set up so that the assets in the trust are exempt and not counted towards that $15,900 limit that I mentioned before for Medicaid eligibility. And so they don't count as the beneficiary's assets. The key difference between the two is that the third party is much more flexible than the first party. The first party, we have a Medicaid payback provision at the end of the beneficiary's life. So the government will say, okay, we understand that you need to rely on Medicaid and you have this windfall, this inheritance or the settlement will allow you, if you're under 65 years old, to move this money into a first party supplemental needs trust. But just know at the end of your life, if there's anything remaining in this trust, Medicaid gets paid back for anything they spent on your behalf. And then lastly, there's a support trust. As I'll mention in one of my slides, not everybody needs to qualify for those means tested benefits, but they need support and they won't be able to manage an inheritance or to pay for things for their lifetime. And then it's your traditional support trust where there's discretionary distributions to meet the beneficiary's needs. So number one, flexibility is the key to success. I'm often dealing with families who will have children that will have lifelong disabilities. And these trusts will often survive 30, 40 plus years after mom and dad have passed away, if not longer. And so my preference is an inter vivos trust, a trust that goes into existence, is a standalone trust. Does not wait to go into existence under a testamentary when somebody dies and a will's probated. And the inter vivos provides a lot more flexibility. We could change trustees without having to go to the court and get successor letters of trusteeship. The beneficiary's needs change. And oftentimes the trust protectors, I'm a big fan of appointing trust protectors in these trusts because they could remove and replace a trustee if it's necessary. or they could change certain administrative provisions of the trust if there's changes in the law. And then, for example, I have a case right now where I have 3 trusts. A sister came to me, she's trustee. She's a 75-year-old woman who's trustee of her sister who's 64 years old and who has mental health disabilities. And throughout their parents' life, they set up 3 trusts. The trusts are very old. And the sister who's my client has her husband's deceased. She has no children. There's no extended family. There's really nobody to serve in that succession after she dies for her sister as trustee. So she comes to me, Amy, what do I do? And we're dealing with a testamentary trust and 2 inter vivos trusts. And the testamentary trust, we have to go through court to change the trustee. And I should mention the combined funds out of all 3 trusts are less than $350,000. So it becomes more tricky in that we're not going to have a corporate trustee available to serve as trustee here. One of the trusts requires that at all times 2 trustees serve as trustee, and another trust says that no trustee can get compensation. And so it's resolving these issues, and the trusts don't provide a lot of flexibility. And so we're looking maybe to decant a couple of the trusts sorry about that. So to decant a couple of trusts. So it depends what state you're in. New York has a fairly flexible decanting law that allows us to basically fix trusts that we don't care for anymore. But then decanting could be an issue because, for example, in this particular case, my client is a remainder beneficiary and she's a trustee, and under the New York rules, she can't decant. She doesn't have the authority. So it's looking at this flexibility when we're drafting these trusts that will survive kind of all these what if scenarios into the future. Gifting. So not a gifting strategy. It's important to think this through, for our clients that have means and they want to start gifting to their children at a young age. They don't realize the scope of the disability, or grandma and grandpa may fund UTMA accounts or 529 accounts. And the child may never need to go to college. What can we do? So in New York, or not New York, excuse me, federal, we have the ability to create an ABLE account, which I'm not going to get into too much today, but it allows us to move what the annual exclusion amount is into an ABLE account each year. So if it's a 529 account that is not, sitting there with $200,000, that's something we could do with a 529 account. Also, if an ABLE account is not an option, and it's a significant 529 account that was contributed to over many years, it can be withdrawn penalty-free, not subject to the 10% penalty, as long as the beneficiary is disabled, but you would be subject to the income tax. Sometimes we use the 529 accounts to pay for other children or grandchildren. And then with the UTMAs, we have to put them into a first party trust if we're looking at means tested government benefits. Also, sometimes with the UTMAs, if there's a guardianship proceeding, because the child will need a guardian when they turn 18, it may end up in joint control with the surrogates court or your local probate court. So just careful strategy when we're thinking about gifting. And I will also say that, oftentimes I'll have clients that have come to me and they're like, oh, I could only give $15,000 a year, or now it's gonna be $16,000. And they don't have a taxable estate. They're under 5 million. Then I say, so what? Just let's give $100,000 into a supplemental needs trust. If that's what you want to do, we file a gift tax return. There's not going to be any consequences because you're not going to be subject to an estate tax for foreseeably at your death. Also, caution with crummy provisions. We want to be very careful with crummy provisions because I had a trust recently that was drafted by a well-respected New York City law firm, and they came to me, help, Amy. The beneficiary was denied SSI, and the beneficiary is in a group home, and they need the SSI. So we had to fix that. So we do not want to give beneficiaries of supplemental needs trusts or disabilities that may need to qualify for means tested benefits, any type of crummy rights or withdrawal, or if we do, we want to have the ability to turn it off, for the trustee to turn it off. So retirement accounts. We have under the Secure Act, I'm assuming everybody knows that, most individuals are subject to a 10-year rule now. Well, if it's a child with a disability, that we could stretch, they become what's called an eligible designated beneficiary, and you're able to apply the old rules and stretch their the retirement asset out over their lifetime. And you could name the third party SNT as the beneficiary, and that's appropriate, and that's well. We want to put accumulation language in there, not conduit, pass through. And it's also important that you don't name any charitable remainderment of that trust, because then we will not get the stretch out. We want to make sure there's only one beneficiary. The disabled beneficiary is the only beneficiary of this type of trust. It cannot be a pot trust for multiple children unless if all the children are disabled. What happens is they'll look through the trust to the remainder beneficiaries, and they'll look at the oldest beneficiary and withdraw over that life expectancy. But again, most of the time we were able to get the stretch out over the lifetime of the trust, which is, great. Trustee selection. Carefully consider an appropriate trustee. Can they do their job? Factor in the beneficiary's disability. Are we dealing with a beneficiary who has a significant mental health disability? And maybe a sibling or family member is not going to be appropriate. Is the trustee a potential remainder beneficiary? Oftentimes we'll have this inherent conflict where the trustee is a remainder beneficiary because it is a sibling, and they just need to do the job properly, and make sure that they're not going to do anything to put their own interests ahead of the beneficiaries. Oftentimes there's not sufficient assets in the trust for a corporate trustee to serve. Usually, it's going to be a minimum of $1 million for in the trust for a corporate trustee to agree, and that's a minimum. So that won't apply to every situation. It applies to some, and that's great. And then also with my older trust that I'll meet with a client who's created a supplemental needs trust 15, 20 years ago, and they'll name certain corporate trustees that no longer will serve as trustee of special needs trusts. They've gotten out of that business. There's only a handful of corporate trustees willing to serve as trustee of special needs trusts, and it's something that needs to be revisited from time to time. The trustees, and we have some important cases here in New York that talks about a trustee's responsibility and duties go beyond your typical duties as a trustee if you're serving as a trustee of a supplemental needs trust. And it's education of the trustee's responsibility. Sometimes they have to, help apply for certain government benefits, even though they're not the guardian, or they can't make any distributions that will impact the benefits. We want to have the flexibility to replace and appoint trustees in the future. And again, that could be done by an independent trustee or a trust protector. Equal is not always fair. So it depends on the client's circumstance. What are the family circumstances? What's the size of the estate? What are the other children who are potential, inheriting from mom and dad? What's their lifestyle like? And all of these, sometimes, it makes sense to leave less to, a child with a disability because they're being provided for comfortably by the state. They have minimal needs. Other times they're not. They have around the clock care that's privately paid for, not by Medicaid, or they have other needs. And sometimes you have to shift the allocation in greater favor to the child with the disability. When we're dealing with young families who have children that are, still in school or even through college, it's not uncommon to leave everything equally. But as they age, that may change. I have families, I'm a big advocate, especially families that don't have, millions of dollars to be able to allocate, consider an extra life insurance policy for that third party supplemental needs trust. I'm a if the family could afford it, or if it make it permanent, because a term policy, if you outlive the term policy, it doesn't do any good. And permanent insurance for third-party supplemental needs trusts are important. The retirement account allocation. Now, because we could get a stretch out for a disabled beneficiary, I have kind of switched what I recommended pre-2020, where I recommended leaving a lot of retirement assets to non-disabled beneficiaries. Now I'm recommending the opposite, leave a greater percentage of their retirement assets to the special needs trust, so we could get the stretch out and leave other assets to the other children. Qualified, number 6, qualified disability trusts. So on the 1041 of the income tax return on the top left side, there is a box that you could check that says qualified disability trust. What is that? So this is under, I give you the statutory, under the Internal Revenue Code. It provides a personal exemption for a trust if it meets certain requirements. Now you say, Amy, the Tax Act eliminated the personal exemptions in 2017. Well, it did, except for qualified disability trusts. So we're still able to take advantage of this if it meets these conditions. And so for tax year filings 2021, it allows the trust to get a personal exemption of $4,400, which is going up a little bit next year. The trust must be irrevocable. The trust must be for the sole benefit of the disabled beneficiary. The beneficiary must be under the age of 65 at the time the trust is established, and the beneficiary must have a disability within the meaning of the Social Security Act. Grantor trusts do not qualify for qualified disability trust status. And as such, all first-party special needs trusts, and this is a different conversation for a different day, but all first-party special needs trusts are grantor trusts. So they won't qualify. But they're passed through, all the income would be reported on the beneficiary's personal income tax return. But this is just a nice little, added deduction for trusts that can qualify for it. Contingent supplemental needs trusts. So I'm, in my practice, we have always built into all trusts, even for clients where we're not doing any type of disability planning, a paragraph or an article that says that if any beneficiary under this trust or under this will is disabled or needs to rely on government benefits, then their share shall be held pursuant to EPTL 7-1.12, and that's the New York reference of our supplemental needs trust statute. It may be different; it's different, of course, in other states, and so it's just, and this has helped from time to time. This also helps not only for disabled beneficiaries, but that become disabled not at the time the planning was done, but later in life, but also for me wearing my elder law hat now, for somebody who has maybe dementia or some type of Parkinson's and maybe need to be in nursing home care or other long-term care. This is just a good planning. I put in all my wills and all my trusts. And the one exception is you can't do it for spouses unless if it's a testamentary trust. Under federal law, you could only do a supplemental needs trust that's through your will for a spouse. You can't do any inter vivos trusts. Also, it's important to coordinate other relatives planning. You don't have to, you obviously don't need to represent the family, but if you did a trust, have the conversation with your clients that if their parents want to leave something to their grandchild or something else, I give clients what's called a dear family and friends letter and say, we're not asking you to leave anything, but if you did, here's the name of the trust. We ask that you not leave anything outright to my child. Avoid, number 8, avoid a knee-jerk SNT. Not every beneficiary will need Medicaid or SSI or means-tested benefits, whatever they are. And so perhaps consider a support trust. And you can allow a distribution of income. We include triggers sometimes that, we're never anticipating this beneficiary to rely on means-tested benefits. But if they do, then we'll trigger this trust as a third party trust. for that beneficiary. And we have not had issues in New York. I don't know if other states, but in New York, I've not had issue with that. Number 9, beware of forms. Okay, so common mistakes that I see. So if you ask, if just be careful with not tailoring or doing an appropriate trust to meet the beneficiary's necessary needs. These are just common mistakes I have seen that I see regularly often throughout my practice, including first-party supplemental needs trust provisions in a third-party trust, including Medicaid payback, or this trust is established pursuant to 42 USC 1396 PD 4A, because that's what some practitioners think that is needed to qualify a trust as a supplemental needs trust. But what that statute says is it's a first-party special needs trust. And so, be careful of that. As I mentioned before, we don't want to give SNT beneficiaries crummy rights of withdrawal. It causes a lot of problems. Not always, it doesn't always get picked up, but it does from time to time. And I'm just coming off a big case where it was a significant issue. Requiring mandatory distributions, like the income shall be distributed to my beneficiary. Or that the beneficiary can demand, like has a 5 and 5 power to withdraw the greater of 5% or $5,000. That's available asset to the beneficiary if they're on Medicaid or SSI, or even subjecting the distribution to a HEM standard, that health, education, maintenance, and support. That health and support is enough, having that language in there is enough for Medicaid or the Social Security Administration to say, nope, we're not providing any benefits, because this trustee has the responsibility first to provide for that. And then giving the beneficiary a general power of appointment. It's common in sophisticated trust and estates plans to use general powers of appointment for various reasons. But we cannot do that for a beneficiary of a third-party SNT, because they have the right to appoint to their creditors or even to their estate, and that will cause Medicaid to claw into the assets. Number 10, not involving a special needs attorney early enough. I have come in several times or regularly, each year of cases that are, well into the planning. And sometimes we have to reverse certain planning, or we have to, change things, fix things. And, my firm will come in as co-counsel or even as counsel of other firms. We don't step on, their estate planning that they're doing for their client, but they consult with us on the special needs aspect. And that's, perfectly fine. Just think about these issues. These are just 10 issues that I've highlighted today, and I got it done in a half an hour. So, Jonathan, thank you so much for having me.
Great. That was very efficient and packed with information. If anybody has any information or any questions, feel free to reach out directly to Amy or myself where appropriate. And I'll be sure to include Amy's contact information in the follow-up email to this program in case you missed it. The handouts were sent out before the event. They're going to be sent out in the follow-up email following the event as well. So you'll be getting those, and you got them already. Just check your email if you want to pull them up on your screen. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 2 more quick items before I let you go. First, my final program of the year will be held on December 23rd and will be eligible for 3 CPE and 3 CLE credits for accountants and attorneys in New York and New Jersey. I'm running this program to benefit charities. So unlike my other programs, which are all free, this program will require a small fee to participate. I'm having some of my most popular speakers and topics for this event, so be sure to check it out. For more information, check your inbox tomorrow morning or reach out to me directly on my personal email, shenkman.jonathan@gmail.com. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day. Have a great day, everybody.
Thank you.